Welcome back to the deep dive. Today, we're really digging into a fascinating piece of market analysis. Our source material, it's dated November 10th, 2025. And honestly, it's one of the most structurally dense outlooks we've seen all year.
It really is. It's not just, predicting where things might go. It lays out this very precise two-phased roadmap.
Exactly. And our mission today is to unpack that for you. Phase 1, a pretty aggressive short-term push higher, followed by phase 2, a major corrective dip that, crucially, the analysis says you have to see as a buying opportunity.
Right. And that's the critical distinction here, because the analysis draws this really striking resemblance to the price action back in late 2021.
2021. So if that comparison holds, what everyone thinks looks like a dangerous market top right now might actually be incredibly deceptive.
Precisely. The common sense view could be dangerously wrong. It suggests the market often sets a trap right when things feel the most toppish.
Like it uses bearish signals against the bears.
Exactly. It's almost a psychological game designed to, clean house before the next move.
Okay, let's unpack this then, starting with what the analysis calls the deceptive topping signal. So the big technical pattern everyone's watching on the ES, the S&P 500 futures, is this megaphone, right, or a rising wedge. Normally, that screams top ahead. But this analysis says, no, that's the trap. How does that work? How does a bearish pattern become bullish?
Well, it's all about liquidity and positioning. See, markets rarely just gently roll over from a peak if everyone's expecting it. The market needs to force people out. So the deception comes when the price actually breaks the bottom trend line of that megaphone.
Okay, so it looks like the breakdown has started. Everyone panics.
Exactly. That break triggers a wave of stop losses. It sweeps up all that liquidity, what the source calls liquidity pools, just sitting below that line. And this causes a really sharp positioning unwind. Everyone who was long gets forced out. And you often see the VIX, volatility spike.
Right. Headlines scream correction. Retail investors bail. Classic capitulation. But looking back at that 2021 parallel, how did that play out? Did it just snap back instantly?
Well, the key takeaway from the history cited is that after that trap, after that sudden unwind, the market pretty much never returned to that low point. Instead, it just went on what the source calls a ripper. I think one past example showed something like a 760-point rally, about 15% over 3 months.
Wow. Okay, so that distinction is absolutely critical for listeners right now. The message is that upcoming trend line break, maybe a 7–10% dip, that's not the big one. It's not the top.
Correct. The analysis is super clear on this. That manufactured drop is what they call the major bottom. That's where you reload.
So you need the conviction to buy into that fear, basically.
It takes preparation, definitely, and maybe some courage, right?
Yeah.
To buy when everyone else is hitting the sell button. But the structure suggests the market is just clearing the deck, getting ready for the next big leg up.
Okay, so let's zoom in on the immediate path. The next week or so seems laser-focused on one single event, NVIDIA earnings on November 19th.
Yeah, NVIDIA is, without a doubt, the linchpin right now. The source makes a really strong point that the NVDA chart and the NASDAQ Q, the QQQ chart, they're practically a carbon copy of each other. So
Yeah.
NVDA is the main driver for the whole index. Its fate is the market's short-term fate.
Which sets up phase 1 of this plan, this super bullish window between, now and November 19th. What's fueling that? The analysis mentions seasonality, buyback windows opening.
Right, all those are tailwinds. Plus, you've got key technical levels overhead, open gaps, inefficiencies.
Right.
The market tends to want to fill those. And the primary target mentioned is that open gap on the NASDAQ Q around 26,000. That seems to be the immediate destination. So the bias is just strongly long until that NVDA date hits.
But then we hit November 19th and everything shifts. Phase 2, the seismic shift. This sounds like where the rug gets pulled, potentially driven by a classic sell the news reaction.
That dynamic has been incredibly consistent this earnings season, hasn't it? You saw it with Microsoft great numbers, but the stock dipped afterward. It seems traders are using strong earnings as an excuse, really, to de-risk, to take profits. So the expectation is that even if NVA reports fantastic earnings, that event itself could be the high water mark, the catalyst for the pullback.
And there's justification for taking profits too, right? The market's been on a tear.
Absolutely. The source notes we've just printed, 7 consecutive monthly bullish candles since the April bottom? That's pretty rare and, frankly, unsustainable without some kind of pause or reset. It definitely warrants some profit taking.
Yeah, 7 months straight up is a long run. But let me push back slightly here based on that huge run. If we're up that much, why is the analysis so confident the dip will only be 7–10%? Why not something deeper, say 15–20%? Wouldn't that break the 2021 parallel?
That's a really fair question. I think the analysis is implicitly banking on the underlying strength of this bullish structure. The idea is that institutional money that missed the run or wants to add will step in aggressively to defend those recent higher lows we've made. So while a deeper correction is always possible, the higher probability scenario, according to this source, is that 7–10% positioning unwind.
Okay, so the core strategy remains. Be aggressive long into the 19th, then take profits or go risk off right before, brace for that dip, and prepare to buy it.
That's the roadmap laid out, yeah.
All right, let's shift gears to specific stocks. The analysis uses a pretty funny phrase for the AI space right now. The Looney Tunes show.
Huh. Yeah, it does seem a bit absurd, doesn't it? You've got Meta getting absolutely hammered by the market for spending billions on AI infrastructure, that huge CapEx. Investors are shrieking out about the burn rate. But then NVIDIA, is getting massively rewarded for essentially receiving that exact same money from companies like Meta.
It does seem like a disconnect. Is the idea that Meta is just too early and the market will eventually reward that spend? Or is this a longer-term problem for Meta?
The source seems to view it as a short-term imbalance, kind of driven by immediate risk aversion around spending. It actually highlights Meta as sitting in a deep buy zone, calls it a massive long opportunity. They even throw out a potential target of like $1,000 for Meta in 2026. So, yeah, the implication is the market will eventually get it.
$1,000 on Meta.
Yeah.
Wow, okay. Speaking of timing and potential catch-up trades, there's this really interesting historical parallel for Microsoft, MSFT. It's lagging the NASDAQ Q, still below its July highs.
Yeah, this is where technical analysis gets pretty fascinating. Microsoft is apparently forming what's called a double inside 2-month candle.
Yeah.
According to the source's research, this specific pattern has only happened one other time in Microsoft's entire history, back in 2011.
Only once before. Okay, walk us through that 2011 setup. What are the parallels?
Well, the consolidation in 2011 started around July, just like this current one in 2025. And the second crucial inside candle opened in November again, just like now. And back then, Microsoft was also lagging the broader market. Same situation as today.
Okay, so the setup is identical. What was the outcome in 2011? Did it rip higher right away in November or December?
No, and that's the key timing point. The big move didn't happen immediately. It was actually in January and February the following year, so Jan-Feb 2012, technically, based on the 2011 setup, that Microsoft just went berserk. It exploded higher to catch up with the index. So if this pattern holds, the analysis says watch January, February 2026 for potential similar explosive catch-up rally in MSFT.
Interesting. So a bit of patience required there, but a potentially powerful setup based on history. Now, on the other side of the coin, the analysis suggests a primary short setup. Adobe, ADBE, calls it the new Enron. That's strong language.
It is strong language, yeah. The thesis there is pretty straightforward, though. The argument is that Adobe's core business model, creative software subscriptions, isn't well positioned for this AI wave. They see it losing market share. And technically, the chart shows it breaking down from a clear descending triangle pattern. So the idea is, once the broader market turns down after NVIDIA, Adobe could be a prime candidate to short, with a target mentioned around $270.
Okay, a significant downside target there. Any other quick, long ideas mentioned?
Yeah, briefly. Alibaba, Babo, was highlighted. It's apparently confirming another specific pattern, a double inside 3-weekly candle. The expectation there is for it to eventually expand back towards its all-time highs, maybe as part of a catch-up trade in the Chinese tech AI space.
Got it. Okay, let's broaden out to the macro picture, starting with Bitcoin. There's apparently a macro warning sign on the quarterly chart.
Yeah, this is a pretty important one, often overlooked because people focus on shorter time frames. The quarterly chart is showing what the source calls a classic bear market signal. Price takes out the high of the previous quarter, first trapping late longs, and then it reverses hard to take out the low of that same previous quarter. When that structure confirms, it's a major red flag, structurally.
So what's the level? What's the absolute line in the sand for Bitcoin's bull market structure? Where does that big correction risk become very real?
The level cited is $74,000. That's the key higher low that needs to hold. If Bitcoin breaks below 74K, the analysis suggests a really significant correction, like 70%, maybe even 80%, is potentially on the table. Now, short term, this current bounce is viewed just as a counter-trend bounce, expected to follow NASDAQ higher, maybe towards resistance around 112K, before that bigger rest manifests.
112K target short term, but watch out below 74K long term. Okay. What about gold XAU? The analysis agrees it's in a bubble. Quarterly RSI over 92 sounds extreme.
Oh yeah, definitely in bubble territory by that metric. But, and this is crucial, The source stresses how dangerous it is to try and short a bubble. They can inflate way further than anyone thinks is rational, so the strategy isn't to short it
Stay along the bubble. Until when?
until the structure actually breaks. And the key signal for that, according to this analysis, is a confirmed break of the previous quarter's low. Until that happens, you actually look for long setups, believe it or not.
Okay, which leads to this specific swing trade setup mentioned for gold. It has a really high risk-reward ratio, like 7 to 1. How does that trade work?
Right, this is a high probability setup based on market structure. It hinges on waiting for price to complete a specific sweep. It needs to dip down and take out the equal lows of the inside weekly candle structure. Basically, hunt the stop losses below the recent range. The plan is to have a limit order waiting right there to catch that sweep precisely at 38.86.
Okay, entry at 38.86. Where's the stop loss?
The stop goes just below the previous month's low at 38.19. That gives a bit of room, but defines the risk clearly.
And the target for that 7R trade.
The target is way up at the all-time high, 43.81. The thinking is, once those short-term stops are taken, the path of least resistance is back up towards that major high.
Makes sense. Hunting liquidity, then targeting the opposite extreme. And just briefly, to round out the global picture, the Nikkei and the dollar index, DXY.
Yeah, the Nikkei looks very similar to the Nasdaq cube, actually. Really overstretched, 7 straight bullish months, expected to push to a new all-time high and then likely top out around the same time as U.S. indices. And importantly, the DXY, the dollar index, looks like it's shifting back to a bullish structure.
A stronger dollar. How does that fit in?
Well, the chart shows a clear V-shaped recovery, potentially heading back towards 103. A stronger dollar often tightens global liquidity conditions, right? So it could actually help accelerate that post-NVIDIA, the positioning unwind we've been talking about.
Yeah.
It adds a fundamental pressure point to the technical setup.
Got it. Provides that extra catalyst, potentially. Okay, so let's recap that roadmap one last time. The two-phase plan is stay long, maybe aggressively so, into that NASDAQ 26,000 target around November 19th. Then execute a disciplined risk-off. Take profits, maybe even go short on names like Adobe, and wait patiently for that 7-10% dip, the major bottom, to reload long positions.
That's the essence of it, and we connect this all back to the bigger picture. The key lesson really is learning to tell the difference, differentiating between one of these deceptive tops, which are actually buy the dip setups, and a genuine structural market reversal. It all comes down to reading the structure correctly.
Absolutely. But here's a final provocative thought for you, our listener, to consider. This whole analysis leans really heavily on historical patterns playing out again, 2021 structure, 2011 Microsoft. We focus purely on the technical structure today. But think about the fundamentals back then versus now. What were interest rates doing in 2021? Inflation in 2011. How do those compare to today's environment? What single fundamental variable today might be different enough to break the precision of that Microsoft 2011 replay come January or February 2026? And why is tracking that variable just as important as tracking the chart patterns? That's a real question, isn't it? Does structure always win, or can fundamentals throw a wrench in the works? Definitely some food for thought. Thanks for diving deep with us today. We'll catch you on the next one.